Before we get into what just exploded in Shanghai, quick note for the real ones who track this market minute by minute. The big moves never announce themselves politely. They leak through the data first. And what showed up in the silver market today is the kind of signal professionals pay very close attention to. When the Shanghai Futures Exchange opened this morning, silver didn't drift up. It jumped. The first prints came in around $99 an ounce. Not $90, not $92. 99. Meanwhile, Western spot silver going into that same moment was sitting near $88. Right away, that tells you something is off. Because in a globally connected market, two major trading centers are not supposed to disagree by double digits. Arbitrage traders usually erase those gaps within minutes, but today the gap didn't disappear. It expanded. Within the first session push, Shanghai silver traded all the way up to $102, triple digits. Physical demand was chasing it higher. Then volatility kicked in, and the session eventually settled closer to $96. But here is the detail almost nobody in mainstream coverage is talking about. The last physical lot reported during the session cleared near $102. Think about that for a second. The average settlement number says $96. The actual last buyer of real metal paid over $100. Those are two very different signals about what the market believes silver is worth. And when you compare that to Western spot trading in the mid-80s, you suddenly have a price gap that looks less like noise and more like structural stress. Now rewind slightly because this didn't start today. In the days leading up to the Shanghai Open, physical buyers in southern China, recyclers, refiners, industrial desks, were already bidding several dollars above the previous exchange, close just to secure supply. That is usually the earliest warning sign in commodities. Paper markets move on sentiment. Physical markets move on necessity. Factories don't care about chart patterns. They care about securing metal so production lines don't stop. And when those buyers start paying up before the exchange even opens, it means the real demand curve is already shifting. Now, while all of this was happening in Asia, Western markets were doing the opposite. Volume slowed down, liquidity thinned, and price kept hovering below a resistance zone that traders have been watching for days. That zone sits roughly between $87 and $89. 3 separate pushes into that area have failed. Not little rejections either. Full momentum stalls. The market tried to break it, and each time sellers stepped in hard enough to push price back down. Right now, spot is sitting around $86, just underneath that ceiling again. This is where tape reading becomes important. A market that keeps knocking on the same door is usually preparing to break it. But until you get a strong hourly close above that level, not a quick spike, not a wick, an actual body close, the resistance technically still holds. So on the surface, you have a strange contradiction. Shanghai showing triple-digit prints. Western charts still trapped below resistance. 2 stories at the same time. And when markets tell 2 stories simultaneously, it usually means something larger is building underneath. Now add the options market to the picture, because this is where things get really interesting. The implied volatility index for silver options has surged to levels rarely seen outside crisis moments. Traders who price risk for a living are suddenly willing to pay extreme premiums for protection against large price swings. That doesn't happen randomly. Options traders don't gamble on drama, they price probability. And right now, probability says silver could move violently. What makes that unusual is the disconnect between volatility and price. Normally, when volatility spikes, price is already exploding. Here it's the opposite. Volatility is screaming. Price looks almost calm. That type of divergence tends not to last very long. Then another development hit the market today that barely made headlines but matters a lot. Several trading accounts on the Shanghai exchange were suspended for breaching trading rules connected to aggressive order activity. When an exchange steps in like that, it usually means the behavior crossed a line serious enough to risk destabilizing the market. That's not internet rumor. Exchanges protect their credibility aggressively. And if multiple suspensions happen inside a single month, it tells you something important about the intensity of trading behind the scenes. Now zoom out to the delivery side of the equation, because this is where pressure can quietly build without showing up immediately in price. The upcoming silver futures settlement cycle involves an enormous amount of paper metal, contracts representing hundreds of millions of ounces, moving toward the point where they must either be rolled forward or settled. At the same time, the amount of metal registered and available for delivery in vault systems is dramatically smaller. That imbalance does not automatically create a crisis. Most contracts are rolled before delivery, but it does create tension. Because if even a modest percentage of participants suddenly decides they want the actual metal instead of rolling the contract, the system has to react quickly. And markets do not like being forced to react quickly. Now layer geopolitics on top of that structure. Oil prices have been rising again, pushing toward levels not seen since late summer. Energy markets are increasingly pricing the possibility that supply disruptions could appear later in the year. At the same time, new global oil discoveries have been declining for years. Exploration hasn't kept pace with long-term demand growth. That matters for metals because energy costs feed directly into inflation expectations, and inflation expectations feed directly into the demand for hard assets, which brings us to gold. Imports into India have surged again, setting another high for the year. Asian buying continues to absorb enormous quantities of physical metal, while Western analysts still argue over whether the rally makes sense. But the market doesn't move based on consensus narratives. It moves based on capital flows. And capital flows right now are tilting heavily toward tangible assets across multiple regions. Still, discipline requires acknowledging the other side of the argument. Today's Shanghai session showed that even strong rallies encounter real sellers above psychological levels like $100 silver. The move to $102 didn't hold. Profit-taking appeared quickly. Volatility works both directions. The same environment capable of explosive upside can also produce sudden downdrafts if liquidity disappears or broader markets hit risk-off conditions. So the honest interpretation of the data right now is not certainty, it's tension. Physical demand in parts of the world is pricing silver far above Western paper markets. Options traders are bracing for major movement. Exchange regulators are intervening in unusual trading behavior. And a massive futures settlement window is approaching. Individually, those events happen from time to time. Together, they form a structure that serious market participants watch very carefully. Because when physical markets, derivatives markets, and geopolitical signals start pointing in different directions simultaneously, the resolution tends to be dramatic. The only unanswered question is timing, and timing is the one variable markets reveal last.